Hey everybody, I hope everyone's doing well. This video is going to be a brief recap of the Emini 5-minute chart for Thursday, March 6th, 2025. It's going to be a brief video, and I have some thoughts about systems and research and that kind of thing which I want to focus on. I'm pressed for time today, so it might not be a full in-depth review, but I'll see what I can do. So to start off the day, we had a big gap down, and if we look at the price action to the left, we can see, let's just zoom out. The market is in a trading range. Big down, big up, big down. So this gap down will probably get a second leg, but it's occurring in a trading range. And we're testing support. And this is more clear on the 15-minute actually, but look at bar 27. Bad buy signal bar. Market breaks out above it, doesn't retest it. That's going to be a test. Magnet and expected to be support. We gap down basically to it. You can see the market tried a couple of times to break below it and failed. And then you have to wonder, well, if the market's in the trading range and deep pullbacks are common in trading ranges, then okay, this bear breakout, the gap down, will probably get a second leg. It will also probably get a deep pullback. So we're testing support. Bears are unable to break below the support, and then we get bar 7. Big outside up bar with follow through and more follow through. Strong enough breakout, you're probably going to get a second leg up. And the bulls ultimately did get a second leg. But in this case, 16 and 17, those bars are a problem for the bulls. Reversal and follow through, both bars closing on their lows, really strong bars. What's going to happen when the market retests the highs? You have bulls who, let's say, they buy the close of 15, or they buy the high tick. There's some unfortunate bull who bought the high tick of 15. There's a buyer and a seller on every tick. If you can put yourself in the shoes of that trader, let's say you bought the high tick of 15, 16's your follow through, 17, even worse. If you're still in the trade, you're hoping we get back up to here, because 16 and 17 are probably going to get a second leg. And that's in part due to traders like you. You have to think like an institution. Obviously, as a retail trader, you're not moving the market, but you have to think like an institution. And just think logically. And you can, I say this with caution, proceed with caution, but because the more you learn about price action, the more you can rely on your emotions. So think logically about your emotions. You buy the high tick of 15, you're disappointed with 16, you're really disappointed with 17, and now the bears have broken a trend line with strength. And you think about the context still. Big up, big down, big up. Is this a bull trend or is it a leg in a trading range? After seeing 16 and 17, the upside might be limited. So what are traders like you going to do if you're given the chance to exit at the high tick of 15? You're going to be really grateful that the market came back up here. And at this point, the bears are hoping for a double top, you could say higher high, major trend reversal. It doesn't look like it's enough bars for a major trend reversal, but we are in a trading range, and this is a minor trend, not a major trend, and this was a strong trend line break. And the retest had 2 legs of its own, 1, pullback, 2, but we failed to break out to a new high. So the bulls maybe were converting into a channel with higher lows and higher highs, but we hardly got a higher high before we then got a 3-bar bear micro channel. So bears hoping for major trend reversal. You can see a measured move down takes you to support below. One area of what might be support, or at least a test magnet, is the bar 6 high. The bar before an outside bar often gets retested. Outside bars are trading range bars, and you have traders trapped here, bad buy signal bar. If you sold above 6, you're trapped. If you use a wide stop, you scale in, you're probably going to get back to the bar 6 high. And if you did not buy above bar 6 because it's a bad buy signal bar, you're trapped out of a winning long trade. So that creates support here a lot of the time. You have to be mindful about the approach, the market's approach to support or resistance. Do you really want to buy the close of 29? We're testing the breakout point, and there was a rally, big up, big down, but ask yourself if you really want to buy the close or buy the breakout point in a 4 or 5 bar bear micro channel. And if you think about Ali's 10+2 factors, which maybe I'll make a video on that at some point, I think it'd be really helpful. If you think about the 10+2 factors in grade of this breakout, you probably have a 70% chance of getting a second leg down at this point. So probably not the best idea to look to buy. And that's why the price action approach is important, more important than just drawing a horizontal line. I wouldn't advise seeing this outside bar, this open gap, breakout point, and just setting a limit order and walking away. And if you are going to get filled on that, you'd rather see, let's see if we can find a quick example. I thought we had one recently. Here's one, 43. Outside bar with follow through, and look at the approach. Down, pull back, down, pull back, down. 3 bar micro channel, but you can see it's a channel on a smaller time frame. And it's a wedge, testing a breakout point. Here, it's not as clear to me that this is a wedge. It looks like a breakout. So the bears continue to get follow through, and we actually don't get a technical pullback until 35. Odds are sellers above the first reversal will be minor, and we'll get a second leg down. Is 35 through 40 the second leg? Probably not. Markets typically get symmetrical second legs. So there's probably going to be a second leg similar in size to this, and this is one of those scalpers second legs where the first reversal is probably going to fail. There's directional probability. You're probably going to make money if you sell here, but the downside might be limited. It's a low one, and we get a more complex pullback. 41, 42, reversal and follow through strong enough for a second leg. So look at bar 43. And this is one of the more confusing things about price action that I would spend a lot of time thinking about. Is 43 trend resumption for the bears, bear trend, reversal attempt, and then trend resumption, or is it a pullback of the pullback? Because we see this as a bear trend, 42 is a pullback. But it's a strong enough pullback that it'll probably get its own second leg. But the breakout is still minor. Just look to the left and the context. Pretty good bull bars, but even this bar, 42, small compared to 26, maybe the same size as 31. It's not especially big, and it's not really breaking a trend line. We have a high, lower high. We're still below this trend line. But the point is, the big question is 43 continuation for the bears, or is it a pullback of the rally, which is a pullback in the bear trend? And this ended up being a pullback of the pullback. And I hope I'm being clear with that. We have a bear trend, pullback of the pullback. The pullback gets its second leg. What's the problem with 46? 46 might be considered a near always-in flip. The market comes close to flipping the always-in direction, maybe spike in channel, and now we're in a tight trading range. Maybe it's a final flag, it's breakout mode. But here, the bulls really need at least one more bar. Ideally, a bar like 46, similar in size, closing up here, and even then, it's probably still minor. And the reality is what you have here is 2 legs up against a strong bear trend. This reversal is probably minor. Best case for the bulls, maybe they get to the 35 high, maybe the 31 high, but the reality is there's probably resistance there. And whenever you need one more bar, usually you don't get it. So 46, the bears might look at 46 as a great price to sell. 2 legs up in a bear trend. First test of the moving average in 20 bars. And the bulls also might view 46 as a great price to sell. They might look at it as a gift. If you bought above 41, you got 1R, pull back. It actually looks like we tested. If you've heard me talk about an I1R before, this is an example. A bull inside bar, it's reversing the prior bear bar. It goes for 1R. Market retests the stop order price, and then you get a scalp out of it. Because if you're buying here, you're scalping. And maybe you're buying for a swing, but you know it's low probability, and you need to have the calibrated expectation for your level 2 study to know what this trade looks like if it's failing, when it's failing, if you're swinging. But I think a lot of traders are selling here. Bulls taking profits on longs, and bears selling to go short. So what happens? You get a bad follow-through bar when you really need a good follow-through bar, and everybody sells. 48 strong enough for a second leg. Might be a leg 1 reset. Had a couple of legs up against the trend, but this entire trading range might be a bear flag. So 48 is a bar that traders sell below if they're long. Get out of longs below 48. If you exited shorts for any reason, you can sell below 48. Good chance you'll make money. We get a big, small, big bear breakout, but bad follow through at the new low. Remember, the market's in the channel phase at this point. And you might count this as a late leg. 1, 2, 3. And we're still getting lower highs. But the problem with the channel phase for the bears is channels evolve into trading ranges. So you have buyers at new lows. Here's an example where the bears really want follow through, breaking out below this low, and then you get disappointing follow through. It's the opposite of 46, 47 over here. So what happens? Traders buy. Weak rally, 2 legs, 1, 2. And the reality is this bear breakout is strong enough for a second leg, but you don't know how many traders are buying at the 51 high, the 51 low, anywhere in this area, because this rally from 51 to 53 might be strong enough for a second leg. So we retest the lows with a weak sell-off, bear bar, no follow-through, bear bar, no follow-through. You might call it 3 legs down and a double bottom. And maybe here, 1, 40, 51, 59. It's a truncated wedge. The third push did not go beyond the second, or in this case we did. So you call it a wedge, 1, 2, 3. The range is getting compressed. Like I said, the problem for the bears here is that channels evolve into trading ranges. They typically don't break out into stronger trends. So we're in a bear channel. The more likely scenario is we test the start of the channel, which often becomes the top of a trading range. That might be all the way up here. That's the problem with selling down here. Where's your stop and where's your target and what's the probability? 63, a little bit of a give up bar. You can probably, if you're short, probably exit shorts, maybe on the close, maybe above the bar. Bulls might buy, but we have a bear trend line here. And this is the first break of that trend line. Now it's a good trend line break, but now we're testing the top of the channel where there's probably sellers, resistance above. So great looking bull bar, but why is there a tail? And why are we stalling at the top of the range? Bulls need more follow through. And what I say, it's just like 46 and 50. When they need one more bar, they often don't get it. Disappointing bar, and that can lead to a give up. Bulls and bears sell, and that's what we got on 66. Big up, big down, but now we're testing the low of the range. And think about if you sold down here, or think about if you did not buy. You're down here, you're thinking, I don't want to sell because, or you're thinking, I don't want to buy until there's more buying pressure. I want to break out to look to capture a second leg, and maybe you miss it and you're a disappointed bull because you missed the rally. And then maybe you're a bear and you're thinking, we're in a channel, the bulls haven't done enough, I'm going to hold short. And then you hold through this very deep reversal. At this point, bulls and bears are trapped. Bulls are trapped out of a winning position. Bears are trapped into a losing position. Everybody who sold down here or did not buy is disappointed. So what are traders going to do on a retest if the market comes back down here in this general area? I don't know the exact price we're going to test, but maybe it's the high of bar 61, maybe it's the high of bar 62. There's a gap. And maybe it's the lows, who knows? But it's somewhere down here. You're expecting support. The bulls will probably get a second leg. 66 is strong enough that the bears should also get a second leg. Big up, big down, big confusion. Expect deep pullbacks, delayed second legs. So 66 will probably get a deep pullback, and it may be the second leg for the bulls. But 66 should also get a second leg down, which might occur after a deep pullback. What happens? We test the breakout point, 65 low. 1, pause, 2, pause. So maybe a spike in channel, maybe it's 2 legs up, testing a breakout point back to the top of the range, and you expect some sort of second leg for the bears, maybe test the low close of 66. But if you sold in here, you're trapped. So the rally 67 to 70, that's strong enough for a second leg. If we think through the market cycle, another test target might be the low of 68. So maybe support here, support somewhere down here. Bears, leg 1, deep pullback. Maybe that's their leg 2. And in this case it was 72, immediate reversal, because this rally to 70 was strong enough for a second leg. And this is a classic big up, big down, leading to a triangle situation. And the range gets compressed. And the bulls and bears take turns. Strong enough leg up that you'll probably get a second leg, but deep pullback likely. Strong enough sell off or bear breakout, second leg likely, but deep pullback likely. You get the deep pullback, the bulls get a second leg, and that's a pullback for the bears. The bears get their second leg, but this bear breakout's a pullback of this rally, and it goes back and forth. And ultimately, this bull breakout got a second leg after a few attempts up. We eventually tested the highs. So that's going to be it for the review, and I just had a couple of thoughts on system development and level 2 studies. So in my last couple of videos, I talked a little bit about level 2, and I'll make a video on that at some point. But for now, I just want to leave a few words with everybody. And one thing I would say, and I know I keep saying it, but first thing, stick with one idea. Whether it's 1 bar breakouts, breakout follow through, 3 bar micro channel, 4 bar micro channel, pick some sort of breakout, stick with it. Have some filters so that you can really focus on one thing. The one thing I've decided to focus on is 3 bar micro channels where the closes are all in the same direction. So instead of an IBS filter, the way I consider, or the way I've been defining bars, is a bull bar is a bar that closes above its open. A bear bar is a bar that closes below its open. So for me, for example, today, bar 9 was a signal for me. Bar 23 was a signal for me, even though it closed above its midpoint. 29 is a signal. So pick some sort of breakout signal, stick with that idea, and learn market behavior around that idea. So practice counting legs. So, open a spreadsheet on Excel or Google and track, go back to last month or go back to January, go back to sometime fairly recently maybe, and just look at the 3 bar micro channels or the breakout follow through, whatever you choose, and just start tracking what leg did this breakout occur in. How deep was the pullback? Did a 1R stop work? Did a 2R stop work? Did the market reach 1R, a measured move down or a measured move up? How many bars was I in the trade? What's the duration? Just be curious about it, because the great thing about a level 2 study, the idea is that you don't know much of anything. That's great, because the whole point of a level 2 study is to be curious and to do research and to learn. So this is where you get to answer all of your questions. The chart can speak to you. The chart answers your questions. That's one thing that I wish I did earlier. I did a lot of reading Al's books and studying the course and studying Ali, but there's real value in doing the work yourself and proving to yourself that, hey, after 3 legs down, we get 10 bars and 2 legs sideways to up, or a leg 1 breakout often gets a second leg. It's really useful to do these studies to prove things to yourself. And then I think the point of a level 2 study is to collect data. And from there, you can build a system. But you have to collect the data first. And then just build one system. Maybe it's a leg 1 breakout system, and you have a really simple process. And you buy the close, you scale in at 50%, you exit on leg 2, whatever that means to you. The beauty of it too is that you get to define what everything is. You get to define what's leg 1, leg 2, leg 3. You define what a pullback is. You define 1R. That's the beauty of it. And that's why you can't build a system and give it to someone else to trade. It just doesn't work that way. And that's the whole point of my videos. I'm trying to pass along what I've learned from Systems Academy and teach everyone how to fish instead of handing everyone a fish. So I hope that's helpful. And that's going to be it for today's video. So thanks everybody for watching, and I hope everyone has a good night.